Welcome back to the Isn't That Rich podcast. I'm your host, Jill Franks.
And I'm your host, Ashley McVicker.
And lately there's been a lot of chatter about the idea of a 50-year mortgage. And naturally, everyone's asking the same question. Is this actually a good thing for home buyers, or does it just sound good on paper? So today we're sitting down with our Chief Mortgage Officer, John Streeter, to talk through what that proposal really means for us. Good morning, John.
Good morning.
So we'll cover why a 50-year mortgage is being discussed, whether it would make monthly payments more affordable, how much interest a buyer could end up paying over time, and what this could mean for home prices, especially in Southern Illinois. By the end of this episode, you'll have a clear understanding of what a 50-year mortgage is, who it might help, and who it might hurt, and the key things to consider before committing to a loan that lasts half a century.
It's like half of your lifetime. I'm thinking about this and I'm like, do I actually want to be in debt that long?
I even think about a 30-year mortgage and it feels like forever. Right. So, but you know, we talked about this before we started rolling. It's not something that is set in stone yet or going to happen. So we're just kind of talking about the potentials of the
and
effects
kind of
today.
giving feedback as to, is this a good idea? And because we're seeing a lot of people post online, and it's getting a lot of promotion as this is how we solve the housing crisis. Mm-hmm. And so people are looking to this, and really I think people don't need to be looking at this, and we'll kind of go through the reasons why for that.
So when Ashley kind of brought this podcast episode idea to me, I hadn't really heard about the 50-year mortgage. So I mean, maybe for me and anybody else who hasn't even heard about this idea, you can kind of explain what the 50-year mortgage or the concept of what's being
why
discussed
did it
is.
come to be?
And if you're not tuned into the housing industry, not everybody would be. It's not something you probably heard or really care about. But it is something that will impact everybody, whether you're in the housing industry or not. So it came about because home prices are getting expensive, living expenses are getting expensive. So there's been the proposal of, well, why don't we go to a 50-year mortgage? And then Trump got on that bandwagon and decided, let's start pushing the idea of a 50-year mortgage, which usually starts with the government organizations. It usually starts with FHA, VA, USDA saying, okay, we're going to government insure a 50-year mortgage. And so in about the 1930s is when the 30-year mortgage came about. So we've just always been under the understanding of a 30-year mortgage, mm-hmm. but prior to 1934, 15 and 20-year were the standard mortgages. Even until the 1960s, the 20-year mortgage was the standard. But FHA came out with a 30-year mortgage in order to try to make homes more affordable coming out of the Depression, and trying to get home building started and giving people as low a payment as possible. So FDR established with FHA the 30-year mortgage, and it kind of came into normal circles in the 60s. And since the 60s, we've had a standard 30-year mortgage at that point.
Okay. And what's the advantage really of a 30-year mortgage? I mean, obviously it makes the payments more reasonable.
And so I always go back to relating it to the car industry. As cars got more expensive, we started extending the terms. So as I like to joke, I've been in the mortgage business as long as Noah, and I made Noah his first mortgage on the ark. Mm-hmm. So that's how long I've been doing this. But when I got started in the business in the 1980s, a 48-month car loan was the standard. There was no such thing as 60 months at that point in time. In the 90s, we started hearing about 60-month, 5-year car loans. Okay. And a lot of banks were like, oh, we're not going to touch those. Well, now we're already up to 90 months, 85 months. So we're going 7 and 8 years on car loans, and that's becoming the standard.
Wow.
So that's the whole thing about the 30-year mortgage is the longer you stretch the payment over, the longer or the smaller the payment is, and the more you can make it affordable for customers.
Right, and
but
sounds
you pay
good
for it in the long run.
Right, so it sounds good. A lot of things always sound good, upfront, lower payment, blah, blah, blah. But then it's like what you said, it doesn't just affect one person, it affects everybody. And so I'm interested to like dive into all of this and see what it's maybe going to do to our economy if we go forward with it. So on paper, like we said, a longer mortgage sounds like it would be more affordable. And in a way, I guess month to month it would be. But is that actually true? Is it going to be more affordable?
Well, and affordability is somewhat contextual. It's in context. Mm-hmm. It's if I'm looking at affordability as can I make the monthly payment, then stretching it out over a longer term makes something more affordable.
Right.
The whole reason that car loans kept on getting longer and longer is because the optimum payment for somebody to say yes to a car loan was a $499 payment. You get over $500, then people start getting skittish. Now it's probably even higher than that. I'm seeing people with much higher car payments. Right. So the mortgage payment is the same issue. $1,000 a month, $1,000 to $1,500 a month is a comfort range because somebody who's renting is paying in that price range, at least in our market. And if you can keep a mortgage payment in that $1,000 to $1,500 range, then that they feel affordable. But you're going to be paying enormous amount of interest when you go to a 30-year mortgage or a 40-year mortgage or a 50-year mortgage. Right now, we're seeing an average $200,000 home. The payment is about $2,000. It's in that $2,000 range. So that's where we're getting a lot of people who, are really struggling with buying a $250,000 home, and that's where the average 3-bedroom, 2-bath house is sitting in our market right now is $200,000 to $250,000.
So essentially, it could be affordable month to month, like you said, in context. But when you're thinking like long-term planning or just over your life, you're going to be sitting with some debt for a really long time, and you're not necessarily maybe even getting ahead financially.
Correct. And I want to do a lot of relating back to the car industry because that's where we have some science behind it. So people who were doing even in the 6 years, but 6 years is a pretty standard, 72 months is not that crazy anymore, but 84, 90 months, and pretty soon we're going to see people that are going to start stretching car loans to 10 years. But what you have seen in that industry is 2 or 3 years when they want to switch out of a car, they don't have enough equity in that car. And so they're having to take the balance that they owe on their car and add that to the balance of their new car loan. And now they're even further underwater in equity on the new car. And there's actually lenders out there that will do that. You owe $5,000 more than what your car is worth. They're just going to tack that $5,000 onto the price of the new car that you're buying, and they'll find a lender that will finance it. So you're going to start seeing that idea of people who want to upgrade homes in 3 to 5 years, they're not going to have enough equity built up. And unfortunately, there probably will be some lenders out there that will say we can pay off your mortgage and add that to your new mortgage, but then you're just further underwater on a home at that point in time.
Well, and it seems to me, especially in the car industry, your debt's going to outlive the life of your car. And
Correct.
With a 50-year mortgage, to me, I'm thinking, okay, you get in, you buy a house or you build a house or whatever, you're going to outlive, the debt's going to outlive the life of your home almost.
The difference is, but that's an excellent point, the difference is we tend to remodel and upgrade our homes. We put a new roof on our home. We do some upgrades to kitchens. Wiring starts having problems. You have an electrician come in and do wiring. The problem that we're going to run into is financing for all of that. To have the money to do a new roof, generally people are borrowing the money to do that. Right. To do a remodel, people are borrowing the money to do that. There's no longer going to be any equity in their home to be able to borrow from.
Mm-hmm. So what you're talking about, so we'll make this clear for listeners, is a HELOC, like a home equity line of credit. So you've because we have shorter mortgage terms, you're putting more of your own money down on that principal, which
Right.
is essentially, I call it a savings account within your home.
Correct.
And then you would be able to take that and then get these things made. But the longer this is drawn out, the less money you are
Putting towards
putting
the
towards your
actual
principal
Correct.
and getting equity.
Yeah. And so you're going to have situations where, let's say 10 years, you buy a home that's existing, not new. 10 years into the home, you need to put a new roof on it. On a 50-year mortgage, you're not going to have any equity in 10 years.
None?
And
You don't think
none.
any?
None.
I've
Wow.
got some numbers put together in anticipation of some of these questions, and so you'll be shocked by some of the numbers. But you'll have to have a market where homes are appreciating in tremendous value to have equity in 10 years. Well, if that's happening, then we've just kind of destroyed the whole idea
Right.
of making homes affordable.
Right.
Because if we're
It's like
increasing
you're making the problem worse.
you're making the problem worse.
And we can go back to like what's currently going on. So right now we have a 15-year mortgage, we have 20, 30-year mortgage. When somebody does a 15-year mortgage, I want to know, like, what is the main difference? Like, what is the difference? Like, you're going to pay your mortgage off in 15 years and you're going to have how much more of that payment every month, I guess, goes towards principal.
Yeah.
Sure. And
Then a 30-year.
Right
Right.
now. And then if you're looking at 50-year, I mean, it's going to be even
15-year
worse.
compared to a 50-year.
so in rough numbers, when you do a 15-year mortgage, a good portion of your mortgage payment is immediately starting to reduce principal.
Right.
So when you do a 15-year mortgage, and we'll use easy numbers on a $100,000 home,
Sure.
you're going to probably pay back somewhere between $150,000 to $175,000 on that over the life of the loan. So $50,000 to $75,000 in interest charges. On a 20-year mortgage, you're going to be looking at about 2 times. So if you had another $100,000 home, over the life of the 20-year mortgage, it's probably going to cost you a total of $200,000. So you're going to be paying about as much interest as you paid for the house.
Okay.
So you have probably a 50-50 relationship right away as far as principal and interest. A 30-year mortgage, and I did some numbers comparing 30 to 50, on a $100,000 loan, 30-year mortgage, you're going to be paying back about you're going to be paying back $227,500. So you're paying 225% of you're paying that house 2.25 times.
Yeah.
So that $100,000 house now just costs you $227,500.
Wow.
That same house at $100,000 on a 50-year mortgage is going to cost you $361,000.
So you're going to
Wow.
pay for that house
3.5 you're going to pay
Times
for
over.
it 3.5 times over.
Wow.
And
And that's with, I mean, when does equity even start with that? I mean, it could be
So-
years and years and years down
Right,
the road.
because he said it doesn't even start within the first
10
10
years.
years.
So typically a 30-year mortgage, and we've all been, 30-year mortgage has been the norm. And Dave Ramsey comes out against 30-year mortgages.
He hates them.
Yeah.
He
And
hates them so much.
I know. And I'm one of those, you're young, you want to be able to buy a house, and you're truly probably buying a house a little bit more than what you should be.
Right.
We've all gotten out of the idea of a starter home and then selling and buying another home. So we want that home right away, and we're like, well, if I'm paying $1,500 in rent, I can afford a $1,500 mortgage. And so we right away look at what is that in a 30-year time period. So we're all have gotten ourselves stuck into the 30-year mortgage. The standard 30-year mortgage takes about 7 to 10 years for you to build enough equity to be able to draw equity out. Now, in an appreciating market where property values are going up, you may establish some equity in as little as 5 years. A 30-year mortgage, you're extending that out to generally 20 years. If you have a relatively flat market where property values go up by 2 to 3% every year, it's going to take 20 years for you to have any kind of equity built in. Now, people are going to say, well, I have equity as soon as I start making payments. So what a lender is looking at and what a financial advisor is looking at is something more than 20% equity, because we always want you to have 20% equity. So if you ever go borrow more money against your house, you need to owe less than 80% of what that original value was. So on the $100,000 mortgage, you don't have true borrowing equity until you have a balance below $80,000. Because when we do a home equity line of credit, we're going to take the value of the home, immediately depreciate 20%. We're going to say, okay, 80% is $80,000. You have a $50,000 mortgage. We're going to give you a $30,000 home equity loan. If you owe $85,000, we're not going to lend you any money over your mortgage, because we don't have enough equity to give you some additional borrowing power. So some people will say, well, I've got 15% equity. Why can't I borrow that? No lender wants to go to 100% of the loan value and be out there to the full value of the property.
Right.
So we're talking about affordability and we're talking about these monthly payments. How much lower would someone's monthly payment be on and we can use your $100,000 example, I guess.
Good, because that's the numbers I have.
That's what you have So how much lower would someone's monthly payment realistically be on a 50-year mortgage versus a 30-year mortgage?
So using that same $100,000 loan amount that we mentioned, a 50-year mortgage is going to put you at a payment of $602 a month, $602 a month. That 30-year mortgage is only going to cost you $632 a month. So you're getting a $30 savings.
That's it?
By going to a 50-year mortgage. Now, a lot of people are looking at, well, I'm buying a $500,000 home, or I'm buying $1 million home. Even in those situations,
that's not what I was thinking. Like it would maybe be like $300 a month.
Yeah,
for a 50-year mortgage,
like it would feel worth it.
Well, because you look at 50 compared to 30, that's almost. I know it's not exactly half, but you would think it would cut it into.
Yeah, 40% less or whatever.
Well, and people amazingly are shocked whenever you do. So here, I've finally got my numbers in front of me. So on that same situation, let's do $500,000. You're borrowing $500,000, which may be more realistic in the range of why people are looking to do a 50-year mortgage. A 50-year mortgage payment on $500,000 is going to be $3,008, so roughly $3,000. On a 30-year mortgage, it's $3,160. So you're saving $160 by taking the 50-year
dragging
mortgage,
something out.
but you're paying it for 1.5 times more. So, because we said you're paying it 3.5 times over versus 2.5 times over, or 2.25 times over on a 30-year mortgage. So that $500,000 property that on a 30-year mortgage is going to cost you over $1 million, $1,250,000. On a 50-year mortgage, it's going to cost you $1.5 million. So, so, it's
This is not making it more affordable.
No.
Well,
in my eyes, no.
The problem is our economy and our basis for affordability is all becoming centered around a payment.
Yeah.
And it all started, again, with the car industry, unfortunately, is just tell me what my payment is. I want to trade cars every 2 years. Just tell me what my payment is. Get me to that $499 payment, and I'll sign the paperwork. And then people started realizing, well, I can't trade every 2 years because I'm underwater.
Right.
So, well, I'll trade every 3 years. Well, the average person on a car loan that does 6 or 7 years on a car loan, it's going to take them 4 years before they have enough trade equity to trade that car in.
And a car's a depreciating asset. It doesn't go up in value.
It's unlike a house. So that's where a lot of people are going to come in and say, well, a house is different.
Appreciate.
Because it's going to appreciate. Well, therein lies the whole problem. Because the more it appreciates, the more homes become unaffordable. So if we expect a house to appreciate 2 times over, then we're just making homes more or less and less affordable at that point in time. So in the housing market, we want to get to a practical sense where homes are just appreciating 2 to 5% every year and not 10, 20, 30, 50% like they have in past years. When I got started in this business, again, in the 80s and 90s, the average appreciation factor was 2 to 5%. So you would see a little bit of appreciation. At that time, people would buy starter homes. They'd buy a home that they could afford. And then in about 5 or 6 years, they would sell the home, make a little bit of profit, enough to make a down payment on a larger home. That also pushes homes into the market. When I buy a starter home and I move up to another home, that's going to be able to make my starter home available to another family that's looking at a starter home. And that's the other problem that we've created by this affordability situation is people are going, and with a 50-year mortgage, you're going to be stuck in a house. So right now we have a huge shortage of inventory in the market, and that's because everybody has these tremendously low rates, and they're not willing to buy another house and triple their interest rate. If I've got a 3% rate, I don't want to buy a house and go to 6 or 7% interest. So especially a larger home, that's going to cost me more. So I want to stay stuck in my house. I say stuck, but I want to continue to live in my house with that affordable interest rate. Well, if we tie in a 50-year mortgage, it's not just the interest rate, it's the equity situation. If I don't have any equity in it, I'm going to stay in that home. And so the lower cost homes are going to get more expensive because I want to have to sell that house for a whole lot more money to make it advantageous for me to move out of.
Right. There's 2 things that you just answered for me. One was like, okay, they're going to look at these homes and they're the more house, and are people actually able to afford those houses? And the answer is no. They're just getting this 50-year mortgage to pretend like they can afford it almost. And are those homes actually worth it? Because what I'm seeing a lot coming on the market just by, getting on Zillow and searching for homes, because it's something I like to do, is, they have these old homes where 5 years ago I wouldn't have thought they were worth $500,000.
Yeah.
And I looked down the road and there was one for sale and it was like $700,000 now, in an old home that to me, I'm like, that's a tear down home.
Yes.
And but then we're having this problem in at least our area where it's like we don't have the inventory like you said. So some people, if they are desiring home ownership, that's all they have to choose from, kind of.
And that's where the problem comes in, is when, it's the old supply versus demand.
Yeah.
And when demand is high, that's going to increase prices. That's going to make something that should be worth $200,000. If 5 people want that house, they're going to start offering more than what that house is worth. And now all of a sudden that house sells for $250,000. And so now that market is $250,000 for that home, and the next time it goes on sale, if there's not any new homes being built, now that home's going to people are going to try to buy it for $300,000. We're starting to see some of the ramifications of all this happening during COVID, when we didn't have enough inventory, rates were dropping. Nobody wanted to sell their house because I've got a 2% rate or I've got a 3% rate. So when COVID broke and people started buying homes between 2020 and 2023, people were paying, we had 5 and 6 people making offers on homes, multiple offers, and they were making offers more than what the house was really worth. And I've talked to a lot of real estate agents, and we're already starting to see people 2 years down the road, I need to sell this house. I've got to move somewhere, or it's just not affordable for me. I lost my job. I need to buy something else, or I just need to sell. And the agents are coming in and say, I can't sell the house for what you owe. So we're already starting to see people underwater just on the 30-year mortgage, paying too much for the house just a few years ago.
Wow.
And this idea of a 50-year mortgage is going to encourage people to, again, pay more for a house than what it's probably worth, because they can, that $160 that they may save or that $30 they may save sounds good to them. And so many times you lock in with these internet lenders, Rocket Mortgage and some of the other internet lenders, where they're just telling you this is what the payment. You don't even talk about the option of a 30-year mortgage. You don't talk about an option of a 20-year mortgage. And so they're just going to tell you this is what the payment. It makes you great. That's affordable for me. And they lock into that. And then, we just start that process all over again, where you're underwater, you can't sell your home. That means there's less inventory, which means people are paying higher prices for what's out there. So it's just a constant snowball problem.
We talk about interest rates and these, how long the loan is. And so we have these 15, 20, 30-year mortgages. And like right now, from when I've even worked at the bank for almost 5 years, like I've seen the rates go from like that 2 to 3% up to like 7 or wherever we're at right now. If they did do 50-year mortgages, would that affect interest rates?
Yes.
Does that make sense? I don't know if that's a good question, but like, would we ever have 50-year mortgages with a 2% interest rate, or would we have 50-year mortgages with 10% interest rates? I don't know. So I guess I don't know big picture how that affects like the Fed and all of that.
Right. Big picture, you're more likely to have the 10% 50-year rate.
So higher interest rate and a longer term
immediately
loan.
Right now, mortgage rates are in the mid sixes for a 30-year mortgage. They're in the low sixes, high fives for a 15-year mortgage. So we're really getting into an interest rate range that is good for market stability. People want to see 4 and 3 and 2% rates. And that was never a stable market. That was the government doing things to push rates down. That was the whole quantitative easing that we're now paying for with this high inflation. So market stable rates are going to be in the 5s for a 15-year mortgage and a 6 for a 30-year mortgage. 50-year mortgage, an investor is going to want a higher interest rate for them to tie up that asset. If I have $1 million that I want to put in a mortgage-backed security, I want a higher return if I want to tie it up 20 more years.
Yep. So
you're likely, typically you see a 0.5% increase for every term. So a 15-year, if it's at 5.5, 20-year, you're probably going to see it closer to 6. 30-year, you're going to see it at 6.5. Not hard numbers, but that's been the general rule of thumb. So a 50-year mortgage, you're likely to see today at a 7.5% interest rate is where a 50-year mortgage would fall. And interesting enough, I did a calculation on a $100,000 loan. You would actually have a higher payment at 7.5% on 50 years than you would at 6.5% on a 30-year loan.
You're kidding me.
Because of that
it doesn't make sense.
1% increase in interest rate. So then that's going to say, well, then 50-year mortgage isn't viable. So then what will happen is they'll start tweaking rates and saying, well, can we make it affordable at 7%? But then you have to find investors that are willing to tie up money for that long a period of time. Because
when you say investor, do you mean a bank?
Well, actually, no, because most banks don't keep their money invested in long-term mortgage loans. So everybody sells their loans to Fannie Mae and Freddie Mac. Where does Fannie Mae and Freddie Mac get their money? They get it by combining these loan packages and selling them in the stock market as what's called a mortgage-backed security. So investors are going to be pension funds, insurance companies, large corporate companies that are needing to park money in something that is stronger than what they can park with the federal government as a 10-year Treasury index. And that's the 10-year Treasury is generally what we watch to see if mortgage rates are going up or down. It's definitely a higher return than what they can park in a CD. So, and they can only get so much FDIC insurance. So if you've got $1 billion to invest, like a pension fund does or an insurance company does, they're looking for bonds and as well as stocks. And one of the bonds where they can get a good return, and it's a safe return, is a mortgage-backed security. So we're just getting these large corporations are buying money or investing money with Freddie Mac and Fannie Mae. In turn, Fannie Mae, Freddie Mac give us the ability to lend this money out to borrowers because we don't want to have our balance sheet tied up in a 30-year mortgage or even a 20-year mortgage.
Right.
Banks are never going to tie up their balance sheet in a 50-year mortgage.
Right.
So you're looking for investors that are willing to tie their money up for long term to get this money.
Okay.
Yeah, that was my next question is, what does this mean for banks? I mean, what is this type of loan? Does it create more risk, obviously, for lenders, borrowers, everyone?
Creates a huge amount of risk because the fact that you're not going to have equity, most people are going to default in the first 10 years of a loan. They don't default 20 years down the road. So on a 30-year mortgage, the default time period is generally in year 2 to year 10. And so if we have a 50-year mortgage and we're saying there's not going to be much equity until 20 years down the road, banks are going to look at that as being an underwater asset, and we repossess a $100,000 home that had a 50-year mortgage, we may only recover $60,000 from that. And so, and they still owe $80,000 or $90,000. We're going to lose $20,000 in that situation. Whereas right now on a 30-year mortgage, if somebody defaults in year 2, we're probably going to lose some money. If they default in 8 years or 10 years, we're generally going to have enough equity that we're going to be whole. We're going to be able to sell the house for enough to cover the mortgage.
I feel like maybe you just answered the question, but maybe you didn't. For the question I have, so we talk about cars and how they're a depreciating asset, meaning they lose value over time. They don't gain value over time. Houses are typically an appreciating asset. They gain like that 2 to 5%, like you're saying, annually, which is great. But on a 50-year mortgage and a house that's, I mean, gosh, say you buy a house that's already 50 years old, because a lot of the times that's what's on the market.
Correct.
Look at on Zillow and things are 19, 20. Oh my gosh. You know, that's way longer than 50 years. But you get a 50-year mortgage, you live in this house for 50 years. Do we actually believe, or I guess, is there a possibility that those houses depreciate?
Probably if you
don't keep up with stuff?
If you don't upkeep, it's going to depreciate. I mean, we have homes. You can go to any metropolitan area. You can go to downtown Marion, Illinois, downtown Harrisburg, downtown Carterville. You're going to see the homes that were built in the 40s and 50s that are now over 50 years old. And if they haven't been remodeled and kept up, they're the homes that have what we call functional obsolescence. Basically, they're losing value because they don't have the modern kitchen. They don't have, they've got brick that's falling out. They've got basements that were built 100 years ago that have mold or just have water issues. And so just thinking about if I buy a brand new house today or build a new house today and put it on a 50-year mortgage, by the time I pay it off, it's already 50 years old. It's past its life expectancy.
Right.
And so I want to have over a 50-year period of time. On average, right now, a consumer will put in one roof on a house during the lifetime of that home, of their ownership of that home, maybe twice if they had to go through a storm. Heating and air, you're generally going to change over one time. But on a 50-year loan, a roof lasts typically 20, 25 years. Mm-hmm. Now, they'll try to say this is a 50-year roof, but it's like tires. You get 80,000-mile tire, it lasts 40 or 50,000 miles.
Yeah, you can see it on Zillow. It starts sagging in a little bit. You're like, I don't know about that.
So a roof generally, under normal wear and tear, will last about 20 years. And heating and air lasts about the same, 20 years. So on a 50-year loan, a brand new home, you're going to be replacing the roof 2 times, if not 3. You're going to be replacing your heating and air 2 times, if not 3.
Yeah.
The average roof right now is costing $40,000. And the average heating and air replacement is costing $15,000 to $20,000. And so you have to look at, again, affordability. I'm locking myself into a 50-year mortgage. Am I saving enough money to put 2 roofs on that house during its lifetime? Am I saving enough money to put heating and air on it 2 times?
A lot of things you got to talk to somebody about. That's why I don't think you go to an internet mortgage person.
Well, and that you're exactly right. And that's why I even encourage people to start talking, if they have an accountant, talk to an accountant about your finances and financial advisor. We're seeing more and more financial advisors. We are seeing more and more people starting to search out individuals like Dave Ramsey and start listening to Dave Ramsey. So hopefully we'll collectively start making smarter decisions.
Yeah.
But we're still on a society that's all about the payment. Mm-hmm. It's all about making something cheaper.
I think, too, a lot of it's about people just want more. And it's like what you said, people don't want starter homes. And I'm one of those people.
Yeah,
I didn't want like a starter home.
We were talking yesterday, and both of us, we'd rather move into a smaller home, 2-bedroom, 2-bath, than buy a big, like you said, a 5-bedroom, this huge house.
That's older.
That's old that we would have to.
Because we've been seeing, like around our bank, these 2-bed, 1-baths pop up that are right next to each other. But I'm like, if it was just me, or if you were maybe older, widow, something, I think living in quality is better than living in quantity. Mm-hmm. And that's with a lot of things. And so I'm wondering if there's going to be a shift in construction around our area, because a lot of the spec home builders build 3-bed, 2-bath. And it seems that we're seeing some things drop to a 2-bed, 1-bath, or a 2-2. And maybe that's working for people.
We're starting to see a couple of, I talked to some builders 20 years ago about this, and we're finally starting to see a couple of builders get the idea that I can build 2 smaller homes and make $50,000 rather than one larger home and make $50,000. Mm-hmm. For the past 30 years, builders are wanting to build one home that they make a lot of money on rather than multiple homes. So we don't have a lot of builders that are out there building subdivisions and spec homes. They're just building custom builds for right now, and they're making their yearly income off of maybe 2 or 3 homes instead of making their yearly income off of 5 or 6 homes. Right. We've got to start rebuilding the idea of some 2-bedroom, 1-bath, smaller homes. Mm-hmm. We have an older population that is now moving into retirement centers rather than downsizing to a smaller home. They say, I can't take care of this larger home. I don't want a home with steps and a second floor. Right. And unfortunately, the only answer for them right now is to sell and go into a retirement center. There's, we do have some duplex areas that people are buying, but it'd be nice to find some senior community areas where you have smaller homes so that somebody can still have their home, still feel like they're autonomous and not having to move into a retirement center. And we just don't have that market right now because builders have been less incentivized to build smaller homes because they have to build more to make the yearly income that they want to make.
Yeah. Do you think one of like the affordability problems with homes, like, and I'm just speaking maybe in our area, with people around, late 20s, early 30s, why can't they afford them? Is another reason because they don't have good jobs? Are we not getting paid enough? Do people have spending problems? Are these houses just astronomical, or is it a little bit of all of that?
It's all the
kind
above.
of a perfect storm.
It's all the above right now.
And do you feel like that's something that happened after COVID and when inflation went up?
The inflation during COVID and after COVID really exploded things. We're starting to see things settle down. And so if people will not get influenced by the 50-year mortgage or even a 40-year mortgage. 40-year mortgages were talked about in the late 1990s, early 2000 as a solution to stretch out payments. And it never really gained any ground, and a few companies came out with 40-year mortgages, and then they kind of went away right away. So if we keep ourselves from getting swelled up by this idea of making it more affordable by stretching out the payments and just let the economy work the way it should, we'll start seeing things become a little more affordable. We'll see appreciation at a slower rate and allow some building to, now that inflation is going down, we can hopefully see some new building going on to put more homes in the marketplace that will resolve that issue. If we rush for a quick Band-Aid to say, okay, well, I want to be able to afford this $250,000 house, and I can do it with a 50-year mortgage. If we take that attitude, then we're just creating more problems, and we're just putting a Band-Aid on the problem rather than the solution for the problem. As I said, some of the people that paid too much for a house, they're already finding they're locked in for a little bit longer until they build equity because the house is underwater right now. Yeah. So as long as we can kind of live through that struggle for another 5 to 10 years, we can work ourselves out of this problem and allow income to catch up with the cost. Right now, income isn't catching up with cost. Inflation during COVID and right after COVID was 7 to 9%. Incomes were only raising 2 to 3%. The inflation rate is still in the 3 to 4% range.
Does that mean annually? That's
annually.
How much inflation is rising?
Right. So
3 to 4%.
It probably 4 is still high. The feds are saying that we're in the 2s now, in the low 2s, but I'd say the average inflation is probably really 3%, all things considered. But income is still only going up 2%, 2.5%, barely 3%. So if your insurance goes up 3%, and insurance is going up far more than 3%.
If 100%. Yeah.
If your housing cost is going up more than 3%, which it is, if your food costs are going, food is probably the only thing that's at that 3% level right now.
Right.
Insurance is going up more than 3%. Car costs is going up more than 3%. Home costs is up more than 3%. And if your income is only up 3%, you're not able to afford these things. And unfortunately, people turn to rent, and we're now seeing rent go up by more than 3% because, and nothing against landlords, it's just the economy. The economy is making it such that, hey, I can make a higher return by raising rent because people will still have a lower payment than what they can afford buying a house. So people are kind of stuck with, well, I can't afford a $250,000, $350,000 home because it's going to be $2,500, $3,000. But I can get a 2-bedroom, 2-bath apartment or a townhouse or a duplex and pay $2,000 a month for it.
And not be locked in and not be responsible for it.
So we see a high number of renters these days. I mean, there are more rental properties being built than there are single-family residences being built.
Yeah.
Right. I always think of this too, like just to kind of piggyback off of what you were saying is a rising cost of everything, insurance, taxes. I mean, I feel like that compounds when you have everything in your life going up that much rather than just one or two things. I feel like it's not just 3%, like you said. It's everything is multiple. It's compounding, not just one thing going up.
And that's the dangerous thing about getting people the idea that a 50-year mortgage or, again, even a 40-year mortgage would be the solution, because by making that more affordable, in the long run, 5 years down the road, that's going to just make costs even higher.
Yep.
And now I'm locked into this 50-year mortgage that I barely could afford when I bought the house. And now I'm having to pay higher insurance costs. I'm having to pay higher roof costs to replace my roof. I'm having to pay higher costs to remodel my kitchen and those type of things. So it's just going to make our problem a whole lot worse. And we've just gotten into a society where we're not looking forward enough and we're not looking backwards enough. We're not looking at what has transpired.
That's good.
And, Dave Ramsey is one of those, I'm one of those that I'm not a huge fan of Dave Ramsey. It's because, in my opinion, a lot of this is common sense. And he makes a lot of money off of just talking common sense. But that's not his fault. He's out there talking common sense and people are willing to buy his products and good for him. But he's one of the ones that's really stoking the fire about the 30-year mortgage was never really a solution to our housing market. And we can see if you look over the years since the adoption of a 30-year mortgage, there's probably a lot of truth to that. Because right now, one of the biggest factors that people are finding in buying a home is deferred maintenance on a property. So I get into a 30-year mortgage. It makes me afford the house payment. I didn't think about saving money to put a roof on. I didn't think about saving money to put... So now I'm having to take a home equity line of credit out to put a roof on and put a HVAC or remodel my kitchen. And so when people are going in and looking at homes, they're looking at, I need to sell this house for $250,000, but the carpet needs to be changed. Bedrooms need to be updated. Kitchen needs to be updated. Bathrooms need to be updated. So people are walking into homes that are costing $250,000 and needing $50,000 worth of improvements. Yeah. And that's because we've allowed ourselves to lock into a 30-year mortgage and didn't think about saving any money to do these improvements.
You can just give your opinion here. I'm wondering, and I just thought of this question. Do you think that, because this is all over the news, all over my social media, and Facebook is my news, so but the news channels are on Facebook.
Right.
Do you think that this is do you think that the government actually cares if people get the American dream and if they're homeowners? Like, do you think they actually care, or is this sort of like a political propaganda for a specific party?
I don't.
Do you think either party really?
I don't think it's. I think there's political propaganda on both sides with both parties, and as a society, we've allowed ourselves to get caught up in the propaganda, and then we've allowed ourselves to take one side or the other based on the propaganda. So there's going to be a huge amount of people that are going to say, yay, Trump, this is a great idea.
Look what he did,
We got a 50-year mortgage to make housing more affordable. He's going to be long out of office. Some of the people around him are going to be long out of office when we start seeing the problems centered around that. And, I'll probably be chastised for saying this. We're seeing the problems now of things that took place in previous administrations. And what we too much from a political standpoint is we're too much about satisfying the population here and now. It's even when they talk about we're saving money and we're cutting back or we're spending less. And the CBO did a report. The reports that they use is where this money savings is over a 10-year period of time. In 10 years, the president's out of office. Even if the vice president then came in and got in office, is out of office by then. So these 10-year projections of, okay, we slashed this and we saved money over the next 10 years is crazy, because it just doesn't ever happen, because the next administration comes in and then changes the numbers, and so that savings we were going to see over 10 years we don't see anymore. Mm-hmm. And this has been happening from administration to administration. This isn't pointing to any particular.
Right.
It's Democrat governors as well as Democrat presidents as well as Republican presidents have been continuing this problem, and it's because they're trying to satisfy the population. And we as American population just want things cheaper and cheaper and cheaper, and we want it now.
Mm-hmm. It's Amazon's fault.
Look at
Amazon Prime started all of this.
It's not just Amazon. You can go back to say Walmart. You could point the finger at Walmart. You could point the finger at Kmart.
Yeah.
It goes back to you could point the finger at the old Sears catalogs, the old Montgomery Ward catalogs. We have always transitioned to some sort of wish book, and it's, I want this, I want it now, and I want it as cheap as I can get it. Look at the explosion of Temu. This is a Chinese company who's selling Chinese products, and they're selling it cheap, and it's just exploding.
Can't get enough of it.
People are saying they're buying stuff on Temu all the time, and China just came in and said, "Look at the explosion of Amazon. We can do this better. We can do this better and cheaper." Temu is just the Chinese version of Amazon.
Yeah, we're all
and
about consumers.
So we as consumers have to get an idea of remodeling our behavior and saying, enough is enough. I'm satisfied with what I have. And that's the only way that we're going to control this inflationary spending.
Right. I feel like that's a whole nother podcast episode, because we could talk about
it absolutely
all
is.
of this influencer marketing. Every direction that we're shifting is towards more and more consuming, and it's crazy. It's got to hit a breaking point, like you said. So it's insane.
Yeah. So this is my last question, and I feel like you've answered a little bit of it, but if the Band-Aid is the 50-year mortgage, what's the real resolve to the housing home ownership problem? People not being able to afford it.
Again, you get into a lot of opinions, and this is just going to be my opinion.
Totally fine.
And this is going to be based on my experience over 40 years of seeing where banking was 40 years ago. And really, I can say that I've been in banking for 50 years. My father was a president of a bank, and so I've seen the banking industry since I opened a checking account in 1976. But we as a nation, we as a population, we as a society are going to have to do a financial reset. We're going to have to go through consumer credit counseling, just like somebody who's got too much credit card debt. We're going to have to recounsel ourselves in being satisfied with a little bit less. We're going to have to quit asking the government to satisfy and resolve every situation for us and say, how can I resolve this situation for myself? I'm not sure that we as a society are prepared to do that. Unfortunately. But we're going to have to probably see some regression in home prices. Nobody wants to see, absolutely nobody wants to see a depression. Nobody wants to see a recession. But we probably need to go through a recession to backtrack on some of the values, some of the inflation, and unfortunately a recession means job losses. Job losses mean foreclosures. So it's not a good situation, but It's just like every situation in nature, you have to have a reset. And that reset is usually going a little bit backwards to take 2 steps forwards. And in the last 20 years, our nation has just not really been willing to, as soon as we hear the word recession, it's fight, fight, fight to not let that recession happen. Trump wants to give $2,000 out because he's been collecting tariff money. Use that tariff money to pay down debt.
Right.
All you're going to do is the $2,000 from tariff money is going to do the same thing that the $1,600 did during the COVID. It's going to cause inflation. It's going to put money in pockets.
Pay it back.
We're going to pay it back through taxes.
Yeah.
And we're all getting overtaxed. And that's the other issue that we didn't even really touch on with a 50-year mortgage, all the different things down the line that this is going to touch. It's going to have an impact on real estate taxes. It's going to have an impact on insurance costs because you're going to have higher insurance values. Tax man's going to want to tax you higher because you're paying more for a house. You're just getting the payment lower, but you're paying higher prices. So the tax man's going to come in and charge you higher taxes. So the only real fix is to have that reset. And I don't know that we're prepared to go through that reset.
Yeah. And I think, let's say we don't go through that reset and we don't know what's going to happen tomorrow or a week from now, but you're also in charge of your own life and your finances. And I mean, I say that as an encouragement that people can really start to learn about some things, like take this time that things are coming out and learn about what all of this means. Like, this was so great today. Like, I've learned a lot.
Yeah.
And really ask yourself and look at your own life. Like, what do you want? Do you want to rent for the rest of your life? Would you rather someone take care of the grass? You know, those things. Or is it really your dream to own a home? What type of home? And then, you know, set your own path and look at your own finances. Like, go for what you want in life.
Correct. And it has to be, individuals all have to look at their situation. And I've started talking with a couple of finance people. One of the things that I hope to do in this next year is put together basically a financial ministry, something that similar to what Dave Ramsey is doing, but at free of cost. So I've talked to a couple more financial advisors to where rather than just first-time home buyer programs, to have financial counseling programs where we have a mortgage person, we have a financial advisor, we have an investment advisor, we have an insurance person, and we come in a setting and hopefully get people to come in and just talk about, you know, what are the things that I need to do? Where do I go to get my taxes done? Where do I go to get the best interest rates? Where do I go to get the best credit cards? And try to bring that back home rather than on the internet. The internet's great, but the internet is just leading us to be a bigger consumer. As you said, with the influencers, it's influencing us to do more rather than do less. And I'd like to see us do some more financial counseling to try to get people to be more practical and more smart, more intelligent with their finances. And we as a bank have been doing that through different programs that we've offered out there. So I would like to see more banks doing that, more financial advisors doing that.
Yeah, I like the idea of teaming up. You know, we're all all of the banks are looking out for the wellness, the financial wellness of our community. So if we could work together and join our forces in that would be pretty incredible, I think.
You know, an interesting thing that's kind of off topic, but just to give you an idea, years ago, and I'm sure it's still true today, about how money is just moving around. And as banks, we're always trying to come to us. We provide great financial services, so we're always trying to get that edge. And so one bank is getting a little bit more market than another bank is. So I looked at Williamson County as a whole, and this was about 20 years ago, and looked at, are we truly getting more money, or is money just shifting around? And over a 10-year period, there was no increase in money in Williamson County. It was just one bank was doing a little bit better than another bank. So this bank got a little bit better market share and another bank got less market share. It wasn't that $10 million came into the economy that went to that bank. It was $10 million moved from a couple of banks over to this bank, and then in a few years that money moves to another bank.
So interesting.
So right now we're just shuffling money around. We're not actually increasing new money. And a lot of that is because in Williamson County and in Southern Illinois, we don't have any primary industry. We have secondary industry. We have all these industries that are just selling services and selling products. We don't have, we have Eisen who's building products, but Eisen is one of the few, and we have Continental Tire that's building products. Those are probably two of the few companies that we have that are actually building products that are being sold elsewhere. Otherwise, everything else is coming into our economy and just being sold, and then the money is just being shuffled around. And so we've got to find ways to bring money in. That's why incomes are not increasing,
Right.
and why housing is growing faster than what incomes are increasing.
So interesting. This has been fun, John. Is there anything we forgot to ask you that you think that it's important that
No,
we
I think the last thing is just, if you happen to have the ability to talk with your state legislature and your federal congressman, if you know these individuals or if you communicate with them, just let them know that we're not 50-year mortgage, 40-year mortgage is just a bad idea.
Just a Band-Aid.
And where it will start is a lot of people are saying, well, it won't come about. We won't see that. Where it starts is it starts with the federal government will start with FHA, and FHA will come out with a program. Well, then lenders have to compete with FHA, and so then lenders will come out with a program. Freddie Mac and Fannie Mae will come out with a program. So this is a program that isn't any good for anybody and provides no benefit in the long run. And I hope this is one that just gets swept under the rug and forgot about for another century.
I probably should have asked this question, but I would be sad if I didn't ask you about this. So yesterday we were just talking about this, and you mentioned that the mortgage would follow you even if you sell your house.
That's another idea that is just becoming crazy.
Yeah.
And because everybody has these 2% mortgages and 3% mortgages, in order to generate people buying another home, another idea Trump has floated out there, I don't know whether it was his idea or somebody floated it to him, is a portable mortgage. And what that is just like you're taking your cell phone number. Your cell phone number can go to, if you want to transition to Verizon, you keep that same phone number. You want to transition to AT&T, you keep that same phone number. You want to transition to a new house, you keep your same mortgage. You transition to another house, you keep your same mortgage. And so the dynamics of it that people won't know is, okay, I have a $500,000 mortgage, let's say. Let's do it in simple terms, $100,000 mortgage. And now I'm going to sell this $75,000 home, and I'm going to buy a $125,000 home. Well, I've got to find somebody who's going to have $25,000 in cash that can give me the $25,000 in cash so that my $100,000 mortgage will port over. I'll still keep that $100,000 mortgage, but I need $25,000 cash to pay the difference on that $125,000 home. So that's the thought process, is your mortgage will port over with you. What people aren't looking at is, if I've got a bunch of equity, for me to port that mortgage over, I've got to come up with cash equity in that case. Or what will happen in the back of my mind is we'll port over the balance of your first mortgage at this low rate, and we'll create a second mortgage for the difference for what you need to cover this home.
I see.
And again, these are just crazy Band-Aid ideas.
I know.
that will allow people to get into a home. So as an example, I would be a prime example. I've got a house that I've got a 3% mortgage on. We want to move out to the country, and let's just say it's an equal home. But I'm telling my wife and kids, I don't want to move because we got a 3% mortgage. I'm not going to buy a house, even at the same money, and take a 6% mortgage.
Right.
So what it allow me to do is if I owe, we'll just say $200,000, if I have a $200,000 home and I owe $150,000 on it, and I'm buying a $200,000 home out in the country, I'll be able to keep my $150,000 mortgage. We'll release it on the house I owe in town, and it will attach to the house that I move out into the country. But I've got to pay that seller $50,000. So now I'm going to have a $150,000 mortgage at 3%. I'm going to take out a $50,000 second mortgage at 7 or 7.5%. And that's how I'm going to port over my low interest rate mortgage rather than buying a new house and having a $200,000 loan at 7%. I'm only going to have a $50,000 loan at 7%.
At 7%. And then the other money would be at your 3%.
The money would port over and stay at that low interest rate.
Do you think that's a good idea?
No, it's just going to create another.
It's like a lot of drama.
It'll create a lot of paperwork. It'll create
a lot of headache for the banks.
And it'll create a lot of incentives for title companies, for court documents. The courthouses will be able to charge more because now we've got to come up with, we want to make money off of this portability issue.
Right.
So,
got to do more work.
There's going to be somebody who's going to say, I'm going to profit off of this idea.
Yes.
And so closing costs will go higher. And that keeps us from that reset option. The whole reset option is I want that home in the country bad enough. So I'm going to sell my house, put it on the market. I want to get rid of this low interest rate mortgage, and I want to get back into a mortgage that's at a stable market interest rate. Right. And so, that's part of that reset option is people buying homes at higher interest rates and getting out of these low interest rate mortgages.
Right. Sorry, I opened up a can of worms with that one, John, but I feel like it was a good point to hit.
Because that's another thing that's been mentioned that is just another bad idea that will just, again, cause inflation down the road, cause more people to profit from the idea of how can I profit from this portability issue. And so for the consumer, it's a bad idea. Sure. Maybe in the short run, but in the long run, it's, again, a bad idea.
Yeah.
Okay. Well, thank you so much. This has been wonderful.
I've saw this, and I've been posting about how bad an idea this is because I'm seeing some companies out there saying, oh, great, we're going to have this 50-year mortgage. And it's just, for mortgage companies and mortgage brokers, all they're looking at is capitalizing off of being able to do a deal. And so if they can do a 50-year deal, that's all they're looking at. They're not looking at what's good for the consumer. So I was excited when you texted me and said, hey, how about doing a podcast on it? Because I appreciate the fact that our bank goes out and talks about these ideas and tries to put information out to consumers and be a good steward and not just be a banker trying to sell another transaction.
Right.
Yeah.
Well, thanks so much, John. This has been great.
Thank you.
I learned a lot. So
I did too. I could keep talking. We're going to talk more after the episode's over.
Yeah. But thanks for everybody for listening, and we will see you next week.
So, Jill, where do we go from here?
Be sure to check out our show notes for this episode, and also be sure to follow us on social media and subscribe to our newsletter. And we'll see you next week.
See you next week.